Hello friends. In this video, I want to share my thoughts about DocuSign, ticker symbol DOCU, and what could be in store next after the massive 42% drop in the stock price after they announced their Q3 earnings. So let's first talk about the company briefly before looking at some key metrics from the earnings announcement and finally discuss valuation to see if it's a good time to buy the dip or wait for lower prices. So DocuSign is a company that offers users a fast and secure way to send, sign, and approve documents digitally. Basically, they help their customers to eliminate the need to keep paper trails and automate their processes with regard to managing contracts and agreements. As their key product, DocuSign offers what they call as the Agreement Cloud, which is an end-to-end agreement and contract management software which can be used by customers to electronically prepare, sign, perform additional actions on signed agreements like collecting payments, and also maintain and manage the digital documents in a secure manner. The company started operations in 2003 and presently has over 1 million paying customers and over 1 billion users worldwide. Their customers include top Fortune 500 organizations, as well as federal, state, and local government agencies. Let's now look at some of the key metrics from their fiscal 2022 Q3 earnings that were announced a couple of days back. As you can see here, the company is growing their revenues rapidly, with the recent quarter bringing in $545 million, up 42% year over year. However, the year-over-year revenue growth has decreased from the 53% that they reported in the last earnings announcement. The main reason for the drop in the growth rate is due to the unexpected spike in revenues that they saw in the previous few quarters, as many customers started using their services during the peak of the lockdowns. Now that things are slowly opening up, the need for electronic document management may not be that critical, which is likely causing the slowdown in the revenue growth. I would think that their existing customers will continue to use their services as long as they continue to offer quality products at a competitive price. The bulk of their revenues is also subscription-based, so it is good to know that these revenues are recurring in nature as long as DocuSign can successfully retain their high-value customers. The customer base growth has also been very impressive, especially the 52% compound annual growth of enterprise and commercial customers, which is the cohort that would likely be the key revenue driver for DocuSign for several years to come. In this chart, you can see the net dollar retention rate, which has been pretty steady around the 120% mark over time. This measure basically indicates how much additional revenue continuing customers bring to the table. So the Q3 number of 121% would, for example, indicate that a customer who earlier contributed $100 to its revenue now contributed $121 in Q3 of fiscal year 2022. Moving on, even though DocuSign is still in a massive growth phase, they are still very profitable. This is not typical of companies in their growth phase, so this is definitely a huge positive that would attract potential investors. I am particularly impressed with the double-digit growth in the free cash flows, which indicates that the company's revenues are growing at a much faster clip compared to their expenses. Now that I have got all the good news out of the way, you may be wondering why the stock price crashed over 40% if the company reported such good numbers for Q3. So let's look at the reasons which caused the stock to sell off. Firstly, as I said before, the market did not like the slowing year-over-year revenue growth, but even more important is the drop in billings quarter-over-quarter from $595 million to $565 million. Basically, at a very high level, billings are a leading indicator of the next quarter's revenues, and a drop in billings is being considered by the market as an indication that next quarter's revenues will not be very exciting. This is also substantiated by the company's guidance for Q4, where you can see that the revenue is estimated to be only between $557 million and $563 million. One key piece of information that the market may be discounting, though, is that the billings for next quarter is estimated to be over $647 million, which would imply that DocuSign could return to higher revenue growth in Q1 of fiscal 2023. So it'll be interesting to see if the company manages to achieve or even beat this estimate. So in summary, the company is still growing at a rapid rate, but the relatively slowing growth rate is worrying investors, and this caused the stock to crash significantly. It also didn't help that overall the market sentiment towards growth stocks has been very negative in the last couple of weeks. My initial gut feeling is that the market overreacted, but now let's look at some scenarios to estimate future revenues and cash flows to see if it is a good time to buy the stock. So here I have listed 3 scenarios where I have estimated the company's revenues and free cash flows for the next 5 years and used these estimates to evaluate what the price of the stock would be in 5 years' time. As you can see, in the first scenario I have estimated a 20% annual growth in revenues, 25% annual growth in scenario 2, and a 30% annual growth estimate in scenario 3. I have also estimated the free cash flow and the price to free cash flow multiple in all 3 scenarios. Based on this, by purchasing the stock at the current price of around $135, you can see that we lose money in both scenario 1 and 2 as the estimated market capitalization is way lower than the current market capitalization. Even in scenario 3, with 30% revenue growth, it still looks like we will only make a very modest gain. Of course, the stock price can go much higher or lower based on market sentiment, but by plotting these scenarios, I feel it will give us a sense of control when deciding to invest, instead of blindly buying or selling the stock based on the market sentiment. So from these scenarios, it looks like it is better to probably wait for lower prices or use dollar cost averaging to buy in small quantities as the price trends lower. I still think the future revenues and cash flows will at least reflect the projections in scenario 3, but I am not very sure how the market will price the stock in the short term. With that said, I actually ended up buying the stock at $139, but also bought a $140 put option expiring in January 2024 for $38 to limit my losses in case the stock price doesn't go up in the upcoming quarters. This way, I can hold on to the stock peacefully, knowing that the maximum I can lose is $38 per share in the next couple of years if the stock price doesn't appreciate. Also, since I have 2 years' time left in the option trade, I can make several adjustments depending on how the stock price moves in the next few months. And in case the stock moves lower to around the $100 range, I'll definitely be buying more shares as the valuation would be much more attractive at those levels. If you have any questions about the trades I executed or any questions about options trading in general, please let me know in the comments and I'll be happy to respond to your questions. And please don't forget to smash that like button and subscribe to my channel if you liked today's video and got some value from it. And as a friendly reminder, I'm not a licensed investment advisor, so always remember to do your own due diligence before making any investment decisions. That's all I got for now. You have a great day, and I'll see you in the next video.